And they go, why don't, and then people go, I don't know why I can't pass the test. Because you don't come on the last day. Because I just had a student, so you guys, I am trying to stay so current for you, it's ridiculous. I just had a student tell me that he had a test that had a lot of things that were, you have to know how to do as a loan officer. So usually I go through chapter 4 really fast, but last time I did this class, I went through the chapter 4 really slow, and I had a lot of people tell me that they passed. So that's a good thing. So we're gonna go through chapter 4 pretty slow. It's not very long, but it's important that we go through slow so you guys understand it. There's somebody chatting at me. What are you guys doing online? It says, hello. Hello, everybody. I'm wearing my Easter color green. I had no idea what I was gonna wear. I don't know what I'm gonna do half the day, right? All right, so let's do this. I guess I need glasses too, just in case. You know, I could wear my bright pink ones. That'd be cute, right? All right, so Respa is my favorite thing. Is this where we left off? Do you guys know for sure? I'm on page 72. Is that where we were?
72.
72 at the top on the right, right?
Mm-hmm.
Cool. It says, misleading use of the consumer's current lender's name unless the advertisement also discloses with equal prominence the name of the person or credit making the advertisement. Okay, so what that is, those misleading things you get in the mail, I don't know if you guys ever got those in the mail. Thank God I teach what I teach, because when I see the stuff that I see from the class, I'm like, God, I should keep some of these. It's where you open it up and they're like those, have you ever had those envelopes where you have to, it's perforated on both sides and then you have to pull it all apart? And then it looks like it's from your real lender and you're like, I wonder what they're offering me. And then you read it and you think it's this really good offer from your lender. And then at the very bottom in tiny, tiny print, it says this is an advertisement. Well, this right here says they're not supposed to do that. So misleading advertising. The next one down says misleading claims of debt elimination. So refinancing and paying off your debt is not debt elimination. It's debt transferring, right? Okay, so if you take out money out of your home and you pay off your debt, you're not eliminating your debt. Number 4, advertisement must not use the term highlight counselor. We are not counselors, we are loan officers or loan originators. So don't say you're a counselor. Number 5, the foreign language ads. So if you do a foreign language ad, you can't do the disclosures only in English. You have to make sure that if they can read it, they can read the whole thing, okay? Good news, we're on Respa. Respa is like my favorite thing to teach because it's super easy. You like easy stuff? Didn't we go over Respa already, sections 6, 8, 10, and 9? Didn't we do that? Did we do that in this class? Talk to me, you guys. Talk to me. It's Friday. Anybody else need a yellow highlighter? Anybody else forget theirs? I have some hiding here. We're getting still adjusted, you guys, online. So there's actually only 4 people missing online now, and still have my people on there. So did we or did we not do Respa in another chapter? Didn't we do it in chapter 1? So we're going to go through it again. It says Respa ethical business practices. In 1974, requires mortgage lenders, mortgage brokers, or servicers for highlight 1 to 4. Remember, you're being tested to help people who are in their family residence 1 to 4. Home to provide borrowers with highlight pertinent and timely disclosures of the nature and the highlight cost of the real estate settlement, highlight settlement process. The U.S. Department of Housing and Urban Development, HUD, promulgated Regulation X, which is implicated and enforced by highlight the CFPB. So you guys, if you're in doubt when somebody asks you, you know, or when you, I mean, you guys are taking a test. I mean, this class is making sure you can pass the test. So make sure you know that the CFPB, they regulate almost everything except for FHA loans. That would be HUD. Make sure you know that. Okay. So drop down to, although Respa was covered in detail, yes it was in chapter 1, we're going to review it real quick. Highlight prohibits anyone, highlight from giving or accepting, highlight a fee, a kickback, or anything of value, circle that, anything of value in connection or exchange for referrals of highlight settlement service providers, okay? Involving a federally regulated loan. Respa also prohibits fee splitting and receiving unearned fees for settlement services highlight not actually performed. Requires brokers and lenders to highlight disclosed affiliate business relationships. Sets limits on the amount of highlight escrow reserves. So escrow reserves was section 10, right? Remember it had 3 sections or 3 or 4 different things you needed to know. at the top of page 73, requires lenders to highlight full disclosure to borrowers about possibility or likelihood that the loan will be sold, or transferred. It requires lenders to provide borrowers with a highlight servicing transfer disclosure if the loan is transferred or sold or assigned the servicing rights. A transfer disclosure is also generally required. Highlight 15. Transfer disclosure is usually required to be 15 days prior to and then 15 days afterwards. So 15 days before your loan is sold, you're going to be warned, and then 15 days after, the new lender is going to go ahead and help you. Oh, wonderful. It looks like my handy dandy internet is down. I don't have time for that. They're going to start texting me and telling me it's down. I don't know why it's not doing it. It says low system resources. Alert your audio quality. They're not complaining yet, but I can see that it's not happening right. So what we're going to do is tell them to go to my YouTube, but I can't do that. I'm just going to do it. Well, I can't do that because it's on, because somebody complained about it. Well, that's what happens when somebody complains, right? I'll just have to send them the video. Can you guys hear me now?
No, it's just disconnected.
Okay, what I'm going to do, I really can't play with this, and this happens once in a blue moon. I'm going to shut you down, and then I want you guys to all log back on, okay?
Yeah, that would be good.
All right. I hate when that happens because I'm not really sure if I'm going to be able to do this correctly. God, no, I don't want to do this. Oh, and this is not good. I don't know why sometimes it does this and sometimes it doesn't. Drop it down. Always technical difficulties, be prepared, right? It won't even let me shut it down. That's how bad it is. I just don't have time for this. End. Come on. It's gone, right? They're gone, right?
Mm-hmm.
It's like, can we just go to YouTube because we know it won't mess up? Okay, it's only the third day and most people won't be able to watch the third day, okay? Here we go. Let's try turning them on. I hope they come back on. Should I start praying right about now? No, this is Zoom. There it is. That's good. But look how slow it's moving. No. The one thing I didn't want to happen today. This meeting has been ended by the host. Okay, but we're starting it again. I don't understand. I mean, we're plugged into the internet, so I don't understand why it does this. I'm going to take your pen away from you.
It's to help you focus.
No, it's not helping me focus at all. Says it's connecting. We're connected. Now let's see if they all show up. Start video. This meeting is being recorded. Okay, we're happy about it. Got it. Join with audio computer component. Go. That was a waste of 5 minutes. Okay, I know. How you guys doing now? There. And I gotta go here. This is called remaining calm. I can sing if you want. I'm just kidding. Zoom's the best one. I know the other one that we have isn't. isn't very fun either. Come on. Why are you not opening? It's even moving slow. All right. Go. You are the host. No kidding. Come on. It's spinning. Not opening, but it's spinning. All right, can you guys see me? Can you hear me?
Yeah,
Okay. Are you guys okay if I? It's blocky. Here's this. Share that. I mean, it's not even moving. I don't even know why is the internet not working today. I can't even understand you. Can you guys Here. All right, I can't play with this all day. It's just not, it's not feasible. How about that? I mean, it's not even, it's moving. I'm very sorry, but we're gonna go live on YouTube. I'm not gonna play with this. What?
Alien talk.
Like I'm supposed to understand that. It's not even moving. I just shut them down again. I'm just gonna put them on and I'm gonna direct them to YouTube. I don't care. Because it's the only way we can do it. Wait, there's the thing.
It finally popped up.
Now the other part comes and they don't come. Why? I always say there's a reason for everything, but I don't have time to lose on the time on this. Chapter 3. So where's my people? They're in here, right?
No. What's the other one, wasn't it?
It started. Can I hide and cry? Doesn't do you any good. There's that. We at least we have the PowerPoint up, right? That's chapter 3, right? Yeah. I should be right on. Hey, look, are they coming back? This thing's crazy. Look at it, it's turning around faster.
Recording in progress.
Oh, she doesn't even sound good. How you guys doing now? How is it now? Hello? Person who's not muted. My microphone's not working. It's just like, if it's not one thing, it's another.
Maybe you just have to turn off the computer and turn it back
I hear sound behind me. But they can't hear me because my thing's muted or it's not working.
In progress.
That was better, right?
Faster.
That was way better. Wait, look. Hey, are we good? Wait. Oh my God, was that a freaking chore? All right, you guys, next time that happens, if it happens again, you guys know my YouTube page, right?
No, we don't.
Okay, well, if you don't know by now, I feel really bad for you. It is making money, write it down, making money in real estate with Sharon Butler. Now,
It's a live video though.
huh?
Okay, I don't see a live video.
What?
I don't see a live stream on your.
It's not live streaming now because I was told I can't do it by my boss. But if we go down and I can't get this back up, we just lost about 8 minutes and I don't have 8 minutes to lose. So what I'll do, huh?
Can you join Zoom from your phone?
You can join Zoom from your phone. Yes, you can.
No, you.
Oh, can I join Zoom from my phone?
Yeah, because you're the one with the internet issue.
Oh, I know that. I could try. But the only problem is the password is the real estate trainer's password, and it's inside the computer, and I don't have it.
Okay.
So if we have a problem at the second half of class, I'll go live on my YouTube page. Okay? That way we won't have to deal with this because we're
You're good now. It sounds clear now.
It's what? It sounds good now?
Clear now.
Okay, so let's just pray and keep our fingers crossed. See, that's what I do when my front door won't open. I'm like, come on, God, please. And my door opens. It's the craziest thing. My roommate are like, this is crazy. I'm like, you better start believing or you won't get in the house. Anyway, so this is where we were. We were at the bottom of page, when we're almost on the top, right?
Or Respa violations.
Respa violations. We already did them once. So remember the escrow ones. At the top of page 73, it requires lenders to make full disclosures to borrowers about the possible. Oh, we already did that one.
Yeah.
And we talked about the transfer servicing. A Respa violation is $10,000, up to 1 year in prison for a kickback, and up to 3 times the amount charged if you don't give your borrower the right to pick their own services. Respa violations examples. You guys can read examples on your own. You can make up our time that way. So those are just scenarios. So go to the fair. Yeah, I saved it. God, where have you been? No, I'm just kidding.
Working? Everything good?
Oh, no, we had a major problem, but we're good now. And we're about 10 minutes behind now.
Cool.
Fair and equitable treatment. So over to that. Fair and equitable treatment in housing is a real estate transaction is the right by law. Highlight Equal Credit Opportunity Act, which was also covered in Chapter 1, is highlight Regulation B. Specifically prohibits illegal discrimination. Highlight prohibits illegal discrimination in granting credit to people. In fact, no borrower should ever be highlight and circle the word discouraged. And that's super important. Because they're going to give you guys scenarios, and in the scenarios, what they're going to do is they're going to ask you if they were discriminated against. So on the fair and equitable treatment, they'll give you a scenario, and then they'll say, what would you do? And then they'll give you answers, and you have to figure out. So you have to understand it. Don't ever discriminate against anybody, and don't ever discourage them for filling out an application. Drop down to the next paragraph. 2 other federal anti-discrimination statutes that have tremendous impact on the real estate transactions is highlight the Civil Rights Act of 1866. Yes.
I sent them all an email for a survey.
Oh, okay. Oh no, I hate those surveys. I'm just kidding. And then highlight Title 8 of the Civil Rights Act of 1968 is commonly referred to highlight the Fair Housing Act. Civil Rights Act of 1866. Title, highlight 42, prohibits, highlight public and private racial discrimination. Drop down to 1866. The Civil Rights Act of 1866 applies to highlight all properties, highlight real and personal, residential and commercial. And go over to the next page. The court, so if somebody's been discriminated, they can sue in court. A person who's been unlawfully discriminated can sue under the 1866 Act. Only in highlight federal court, the court fashions the remedies it finds necessary, which includes highlight injunctions, highlight compensatory damages, and punitive damages. Drop down to the Fair Housing Act. highlight Title 8, highlight 1968, is commonly called highlight the Fair Housing Act. The Fair Housing Act highlight expanded the 1866 Civil Rights Act, making it highlight illegal to discriminate in the sale or lease of a residential property. You guys have to make sure you know your protected classes. Although there may only be a couple of questions, you have to know them because of the way they're going to ask them. So based on race, color, religion, national origin, sex, disability, and family status. You should have that little piece of paper that came in your book that hasn't. Okay? Although the Fair Housing Act prohibits discrimination in the housing against people with disabilities, so you can see that disability is the one that's almost at the bottom. The Highlight Americans with Disability Act came out in 1990. So I've had students tell me that they'll get, this one guy took the test like 5 times. So every time he took it, he told me it was on each different test. He didn't do that on purpose, just to tell me it was on the test. He just couldn't get past it. And he said one of the tests he got was all on the rights, the different things that you had to know, and you had to know what it was, what it had to do with, and what year it was.
Wow.
Yeah. So the name of it, what it was for, and the year. Okay? So the Fair Housing Act covers most residential transactions in the United States, although there is highlight following exemptions. So there are exemptions in the Fair Housing Act. Everybody says, oh, there's no exemptions to the Fair Housing Act. Yeah, there is. And these are the 4 right here, so you need to put a star by them. A rental of a room or a unit in a dwelling of no more than highlight 4 independent units, provided the highlight and put a star by it. Owner occupies one of the units. So if the owner's living in the property and renting them out, he or she can rent to whoever they want. Next one is a single family home, highlight sold or rented by highlight private owner without using a broker. Next one down, highlight housing operated by organization, and highlight organization and highlight private club. Those are your 4. Advertising, prohibited advertising discrimination. The Fair Housing Act also prohibits discrimination in advertising of a real estate broker, lender, or other services associated with residential transactions. To comply with the act, lenders are required to include the highlight equal housing lenders slogan on any highlight broadcasted advertisement. So the broadcasted advertisement, when you hear a mortgage company advertise on the radio, or you see or hear something on the TV, they always say we're an equal housing opportunity lender, and then they say all that other stuff really fast. Okay, they have to do that by law. They don't all just do it because they want to. But you're supposed to be able to hear them and understand them. And in order to make sure that they're doing it the way that they're supposed to, they have to give you an 800 number, so that if you didn't understand what they said, you can call them. Display the equal housing opportunity poster, highlight poster, equal housing opportunity poster in every branch where highlight a mortgage loan is made. And on all your advertising, you should have the equal housing opportunity logo on all promotional material. So like some people have it on their business card, but for the most part, advertising is like flyers, door hangers, anything that you have that's printed material needs that equal housing sign. So I did an open house with oh, it slowed down again. I did an open house with some people, and what ended up happening was they already had their flyers, so I made flyers with the property address on it and with my information, and then I put, everything was done in teal, and they had a teal equal sign. It's so cool. I don't know what I'm going to do with these people, because I don't have time to keep playing with it. I'm going to ask her to play with it. How about that? Give me a second. She's still here. Evelyn, where is she? Okay, the thing keeps going down. This is the 3rd time I can't continue it. It's sticking anywhere somewhere. The internet keeps going down. The internet is down again. Yeah, I can go live on YouTube. Well, I already told them if that happens again, I'm going to do that because it's the last class. I get that, I understand that, but I'm going to be late. I'm not going to get done with class. If we can't afford the right internet, then I can. All right, so I could send it to them with the link when I'm done. All right, so we're gonna keep going. They can see it with a link because they can ask for the link. But there's like 28 of them. All right, so where were we, you guys? I hate when this does it because it throws me off.
Prohibiting
Prohibited
discrimination. in mortgage.
Yeah, advertising discrimination. Okay, so we already did the equal housing opportunity logo, and then we have prohibited discrimination in mortgage lending from the perspective of a mortgage professional as set forth by the Fair Housing Act. No one may take any of the following actions if the actions are based on the person's membership and highlight the protected classes. Now, you guys, we're trying to be loan officers, so obviously we want to do loans for anybody that's breathing, right? I do. So some of these things are just stupid to do in the first place. Refusing to make a mortgage loan for somebody because they're in the protected classes. Refusing to provide information regarding the loan, imposing different terms or conditions on the loan, such as different interest rates, points, and fees. Discriminating on the appraisal of the property. Refusing to purchase the loan. Setting different terms or conditions for the purchasing the loan. For example, the bank charging a higher interest rate to a creditworthy borrower who wants to buy a home in a minority neighborhood. Prohibited discriminatory practices. You guys should have learned all these in your 20-hour, and then those of you who have your real estate license, you should definitely know this, is blockbusting. So blockbusting, highlight blockbusting, and highlight trying to induce owners to sell their homes by suggesting that an ethnic or racial composition of the neighborhood is changing, with the implication that the property values will drop. Blockbusting is also called panic peddling or panic selling. Steering, highlight steering. And this is, steering is, the way that I remember steering, you guys, is buyers and renters get in your car and you drive them around, right? So buyers and renters. So buyers would be people who are looking to buy a home. Steering is you're steering them to or away from a particular area based on their highlight race, religion, or ethnic background. Redlining. Redlining, highlight is refusing to make a loan or making less favorable terms on properties located in highlight neighborhoods for discriminatory reasons. Make sure you remember it's redlining, it's not any other color. Should I get my red flag for my red pen so you guys remember red? Redlining. Okay. Go over to the top of page 75. Since it's very difficult for borrowers to obtain purchase or renovation loans, it became enabled for the property market maintain improved homes that caused neighborhood values to decline even further, a cycle from which the neighborhood could recover. Lenders may still deny loans in neighborhoods where property values highlight this, where property values are declining. So redlining is when you're not doing the loan based on their ethnic composition or, you know, with a protected class. But when you move over to the next page, what they're talking about there is a lender cannot do a loan if it's in a neighborhood that it's about the neighborhood, not about the person. Does that make sense? So you guys really need to understand that because that's definitely on the test. Okay, did we lose our guy? What do I have him doing? All right, going on. Exposing redlining violations. The practice of redlining became prevalent in the early 1970s following the passage of Highlight the Fair Housing Act. To combat redlining, Highlight Community Reinvestment Act. You have to know the Community Reinvestment Act goes with HMDA. So the Community Reinvestment Act is for banks in their local areas. Was enacted by Congress in 1977 to reduce discriminatory credit practices impacting Highlight low-income neighborhoods. Encourages financial institutions Highlight to help meet the needs of the credit needs of the communities in which they operate. It requires periodic evaluation of an insured depository institution. Redlining may be exposed through the enforcement of Highlight Home Mortgage Disclosure Act. So remember that HMDA goes with CRA. Regulation C requires that institution depository lenders meeting the following criteria collect, report, and disclose information about the loans made during the calendar year. If they have assets as of December Highlight 31st in the year preceding the data collection in excess of the threshold set by Highlight the CFPB. Maintain a home office or branch office in a metropolitan statistical area. Originate at least Highlight one home loan secured by the first lien on a 1-to-4 dwelling. Originate a loan insured, guaranteed, or supplemented by the federal agency or intended to be sold to a GSE. Highlight originate either 25 closed-end loans or 500 open-end lines of credit. For-profit, non-depository lenders, that's not in a good place.
Sharon, can you tell us just where you are? Because
I'm on page 75, and what I'm gonna do is I'm gonna put this, you guys just text me that you need the video. Now my video is shut off, so I don't know why it did that. It said allow, because she's playing with the thing, so it cut off the video. What is that? We have a monster. Oh my goodness me. I can't win. I don't know, you guys. What is it about tonight? It's just, we're trying to get it to happen. All right, so at the bottom of page 75 where it says for-profit and non-depository lenders meeting the following criteria must collect, report, and disclose information about the loans during each calendar year. Maintain a home office or branch office in a metropolitan statistic area, and originate either 25, I already did that, 25 closed-end loans or 500 open-end lines of credit during the preceding 2 calendar years. Go to the top of page 75. Are you guys on there? Are you good? I see 20 of them. We were so good all week, weren't we? God, everything was so good. It must be God being mad at us because it's Good Friday. I'm sorry. Give them a break. They need to pass the test. Prohibited mortgage fraud. You guys don't laugh. It happens every time I ask. Anyway, being honest with everybody requires MLOs to avoid fraud, intentional or unintentional at all times. It may lead to either civil or criminal penalties. Highlight negligence is unintentional. Okay, so remember, negligence is unintentional. You didn't know what you didn't know that got you in trouble. Breach of legal duty, it's tort if it causes harm. And the MLO can be sued for fraud. That's kind of scary, huh? Fraud is intentional or neglect, misrepresentation, or concealment of a material fact, which can include failing to disclose required information, actively concealing information, and making false or misleading statements. Highlight actual fraud is highlight intentional misrepresentation or concealment of a material fact. Constructive fraud, highlight is negligent misrepresentation or concealment of a material fact. Mortgage fraud involves any misrepresentation or concealment used to attempt to obtain a mortgage loan. It can generally be divided into highlight 2 main categories. Fraud for profit, highlight that, and highlight fraud for property. Fraud for profit is normally insiders, and fraud for property are normally the buyers. Common ways in which mortgage fraud can be committed. Material misrepresentation, such as highlight an altered pay stub or tax return. Material misstatement, such as stating intention to occupy the property when it's really going to be a rental. Omissions, such as failing to mention the borrower is taking an early retirement. That's not good, right? Mortgage fraud perpetrators. I'm trying to see where she's at. She has me in the wrong place. Let me see. I see people coming back. It looks like we're in a good place. Mortgage fraud perpetrators. I'm almost scared to put it right in the right place, right? Because, the second I get everything perfect, I'm not going to say. Mortgage fraud is highlight anyone involved in the mortgage transaction may highlight potentially be involved in fraud. Highlight borrower. Highlight generally comes from highlight 2 forms. Highlight false information, supplying false documents. Drop down to the next one. Highlight straw buyer. So a straw buyer is someone who buys a property for somebody else with the intention of saying that they're going to live in the property when they're really not going to. Mortgage loan originators and lenders can withhold derogatory information to get the loan approved, create phantom documents for verification, conceal the true nature of the borrower's down payment, falsify documents, intentionally make loans to straw buyers, originate loans for illegal flipped properties, or loans for unqualified buyers. Well, if you do any of those things, you guys, just one of those can get you in trouble, so why do any of them? I mean, you're not going to go through this whole thing just to do something stupid, right? Highlight appraisers and put a star by it. I put a star by that one. can inflate property values to hit a number, provide a borrower or a lender by using inappropriate comparables, or by making or failing to make the required adjustments. Highlight attorneys can highlight bogus documents. Highlight accountants can highlight falsified tax returns and profit and loss statements. Highlight title companies charging fees to borrowers for services that were never provided. Highlight government workers falsifying deeds. Real estate salespeople doing all kinds of stuff. Look at, they got 2 paragraphs. Rehabbers or for sale by owner flippers can highlight subpar material and also remove materials or fixtures after the appraisal. Mortgage fraud schemes. Highlight air loan scam, which involves highlight no collateral loan. For example, the broker enlists and creates a straw buyer, uses a fictional property, and opens an account for payment and maintains a custodial account. Well, you probably can't do that anymore because we are so computer literate and we back check everything. There's no way you're going to get rid of that one anymore. Top one, in a deed scam, the seller's signature is forged. Those are the saddest ones because those are usually older people who paid off their home and then somebody forges their signature and sells their home, and because there's no loan owed on it, guess what happens? Their house goes out from under them. So that's why I always tell people, understand how your deed of trust should be and maybe even make it look like you have a loan on it. Or maybe get a reverse mortgage and don't use it. Whatever. But make sure it looks like you owe money on it because that way you won't get it stolen from under you. I don't know what the best thing to do is because people are going to do what people can do if they get away with it, which is sad. Double sold loans. The originator or mortgage broker submits a single application to 2 different lenders or investors for funding, and when approved by more than one lender, they fund them both at the same time, and one funds the loan and one goes into their hand. I don't know how they do that, but there must be some way because they were doing that back in the 80s. And highlight unrecorded or silent second. This scheme involves a buyer who gives the seller a mortgage on the property being purchased and agrees to pay the seller on the loan without informing the lender. So getting a second that the lender doesn't know about. I don't know if I want to touch this, but I'm doing it because I want them to see. Are you guys there? Are you guys alive? Can you see me? I'm keeping my fingers crossed. All right. Are you okay?
Yes.
Yay. All right. Going on, we did the mortgage fraud schemes. Now, illegal property flipping. Illegal property flipping, the best way that I can explain the illegal property flipping is by the one that I actually saw. So I saw one. Illegal property flipping is where somebody buys a home at a really low price and then they sell it to, they have a group of people. Real estate brokers, real estate agents, and appraisers are all grouped together and they're buying and selling the property a little bit more and more and more to each other, and then they get to a point where it looks like the property is worth more, so an unsuspecting buyer goes, well gosh, the last time it sold it was at this much, so it's got to be worth this much. So the one I saw was the house in Anaheim Hills where it sold something like I think it sold for $950, and then it sold for like $1 million, then it sold for $1,020,000, and it just kept going up. It was in a neighborhood of $1.4 million. So when the person got it for $1.4 million and the neighborhood was $1.4 million, they thought that was okay. But the first person who bought it that didn't really do anything to the house bought it for $925,000. Now there's nothing wrong with buying a house low and selling it high if you fix it up and you do something to deserve it to be higher, or if you hold on to it and the values go up. But the property flipping scheme, that's what it is. They're just keeping it going and going and going until it happens. I'm told that none of these attributes to the flipping schemes and the illegal flipping, told that nobody's seen any test questions on those. So let's go straight down to FHA's response to prohibited illegal flipping. You guys have to know these time frames. Here we go. FHA requires sellers to own the property for at least highlight 3 months. So on an FHA loan, if somebody is buying your flip and it's only been a couple of months, you can't sell it to somebody who has FHA until 3 months have passed. FHA, for the resale range from 91 to 180 days, FHA imposes highlight additional requirements to decrease the possibility of illegal flipping. FHA's rule include, FHA will not insure a resale property unless the owner is the owner of record. So the seller has to own the property. Well, that's common sense, right? Hopefully, it's common sense.
Right.
Yeah? Okay. Resales that take place 90 to 180 days after the initial sale on FHA, only if there's highlight a second appraisal that matches the resale threshold percentage established by HUD. The second appraisal may not be paid for by the borrower. Make sure you know that highlight cannot be paid for by the borrower. If there's more than highlight 5% difference in the property value between two appraisals, the lower appraisal must be used. The resale price may not be more than 100% over the price paid by the seller to acquire the property. There are exceptions to the case of relocations. Of course, there's exceptions for HUD, REO programs, approved nonprofits, local, state, and federal highlight government agencies, inheritance, and disaster areas. Next page. Not next page, top of page 77. The importance of an accurate appraisal. Appraisals, let me see if I'm there. I want to make sure I have it right. Okay. Appraisals are a critical aspect of the mortgage lending. An appraisal with inaccurate information, whether completed because of fraud or negligence, can have a serious impact. An inflated appraisal scheme is when the property is intentionally appraised with a highlight higher than market value by the appraiser acting in collusion with the real estate agent or lender. Creditors, mortgage brokers, and their affiliates are prohibited by provisions contained in the Truth in Lending Act from highlight coercing, influencing, or encouraging an appraiser to misstate the value of the dwelling. The law specifically prohibits. You guys, they're going to ask you scenarios about appraisers and what you can and can't do. For the purpose of the test, I'm going to read you what they can and can't do. Now we're down to, we can't even order the appraisal. Like our processor can't even order the appraisal. We have to send the link over to the borrower of the appraisal company. The borrower puts in their credit card information and they order their own appraisal. That's what we just had to do on the last one we did. But specifically it says, implying to an appraiser that the current or future retention of that appraiser depends on the amount in which the value comes in at. Excluding an appraiser from consideration for future engagement because the appraiser reports a value to the consumer's principal dwelling that does not meet or exceed the threshold. Telling the appraiser a minimum report of value of the consumer's principal dwelling that is needed to approve the loan. Highlight failing to compensate the appraiser. Well, so for the purpose of the test, failing to compensate the appraiser. You can't even order the appraisal until you pay them first. So if you're working in the business, it's hard because there's people that are loan assistants or loan processors, and they're like, well, wait, that can't even be right because we have to pay them first. Well, this is part of your test. So know that if you fail to pay the appraiser because they didn't come in at value, you can't do that. It's against the rules, okay? Also, conditioning the appraiser's compensation on the loan consummation. Telling the appraiser, well, I'll pay you if I get paid. Well, you can't do that either. If the creditor knows at or before closing has had any improper, I don't know why I can say that word coerce. I can say it in the beginning, but I can't say it the second time. There it is. So if you did any of that, if they find out you did, it says if the creditor knows before the closing that there was occurred by anyone, a creditor cannot extend credit unless the creditor can document that they acted with reasonable diligence to determine that the appraisal did not materially misstate or misrepresent the dwelling value. The following practices are not prohibited. Asking the appraiser really nicely to consider additional information about the dwelling or comparable properties. Asking the appraiser to correct factual errors. Obtaining multiple appraisals of a consumer's dwelling as long as the creditor adheres to the policy of the most reliable appraisal rather than the highest appraisal. And withholding compensation from appraiser for breach of contract or substandard performance. So if the appraisal's done not very good, you can not pay them, even though you paid them before they went out. Okay? Mortgage fraud red flags. Let's see, appraisal practices. All right. Red flags are not necessarily considered fraud individually. However, if there's more than one red flag, you guys should be paying attention to what's going on. Highlight steering a borrower to a specific lender. Okay. Highlight stated income. Highlight no money due at closing. Highlight sales subject to seller acquiring the title. That's a huge no-no. Highlight difference in the sales price. The sales contract is supposed to guide the title agency or closing agent to the terms of the closing disclosure, and there should be no discrepancies. Sales price changes to fit the appraisal. The sales contract is altered after the appraiser comes back with a higher than expected appraisal. So I suppose the appraisal could go down, but not up, okay? Related parties involved, highlight funds paid to undisclosed third parties. You can't pay money outside of escrow to anybody, whether it's an undisclosed third party or outside of escrow to the buyer or the seller, okay? Mortgage fraud detection and prevention. It says the Federal Bureau of Investigations, that's the FBI, compiles data on mortgage fraud through highlight suspicious activity reports filed by financial institutions with knowledge or suspicion of fraud, and from the reports, the Department of Housing and Urban Development, Office of the Inspector General. The FBI also receives complaints from the mortgage industry at large. Private subscription services such as Mortgage Asset Research Institute is a service of LexisNexis, which gives members access to the database of fraud and suspected fraud as reported by its members. Drop down to the next paragraph. Prohibited predatory lending. Along with the advantages of subprime lending, which extends credit to people who might not be able to get a loan otherwise, predatory lending involves loans that highlight take advantage of highlight ill-informed or desperate consumers through highlight excessively high fees, misrepresented loan terms, frequently refinancing that does not benefit the borrower. The motive of predatory lending is profit. The goal of the predatory lender is to take the property or strip it of its equity or to highlight profit from the fees. Undoubtedly, the lender's claim is to always help the borrower achieve the dream home. Predatory loans are approved without regard to the borrower's highlight ability to repay. Interest rates are highlight higher than the level of risk justified. And lenders may bundle unrelated products such as highlight life insurance policies into the mortgage loan. Predatory lending indicators. According to the Mortgage Banking Association, the following are the 12 predatory indicators of predatory lending. Steering borrowers to highlight a high rate program. Highlight falsely identifying loans as a line of credit or an open mortgage. Structuring a high cost loan with highlight unaffordable payments. Top of 79. Falsifying loan documents. Highlight making loans to mentally incapacitated homeowners. Highlight forging signatures. Changing the loan term. Requiring credit insurance. Increasing interest rates for late payments. Charging excessive prepayment penalties. Failing to report good payment history on the borrower's highlight credit report. And failing to provide accurate loan balance and payoff information. Net tangible benefit. So the net tangible benefit means that it has to benefit the borrower. If it doesn't benefit the borrower, the underwriter has the right not to let you do the loan. So to combat predatory lending and refinance transactions, lenders have implemented a consideration of the loan called highlight the net tangible benefit. The refinance loan must make sense for the consumer by highlight lowering the interest rate and payment according to the lender's guidelines. Drop down to the next paragraph. The net tangible benefit calculation may include a form completed by the MLO showing the benefit to the consumer. Creditors may review the form or perform their own calculations. Because obviously, if their payment might not be going down, they might be getting cash out. So if they're getting cash out because they're going to consolidate their debt, then that might be a net tangible benefit. More predatory lending examples. There's lots of predatory lending examples. Okay, so this is a scenario. You guys can read the scenario on your own. Go over to the HOEPA predatory lending protections. I'm making sure I'm not going past the thing I need to go find. All right. So the homeowner ship and highlight equity protection, because you're trying to save the people's equity, amends the Truth in Lending Act highlight in 1994 and prohibits equity stripping through excessive fees and other abusive lending practices. This is related to highlight high-cost loans, which are also known as Section 32. Remember, Section 32 is high-cost loans. So HOEPA provides consumers protection for loans that are identified as high-cost loans. These are prohibitions on the high-cost loans. Highlight balloon payments, highlight negative amortization, pressure tactics. Loan pricing cannot include more than highlight 2 advance payments from the loan proceeds. Acceleration clauses, prepayment penalties. There are limitations on prepayment penalties, so consumers are not locked into the loan they may not or want to be in any longer than they have to be. Loan flipping, the lender cannot refinance a high-cost loan into another one for 12 months, highlight 1 year. You might want to write next to that 12 months because on the test I believe it says 12 months. And the last one is demand clauses. The loan contract cannot include any provision that would enable the lender to call the loan before maturity, for instance, of fraud, material misrepresentation, default, or damage of the property. I gotta tell you, today I just talked to a guy. It was interesting because he insists it wasn't him. It's not me, it's not me. So he was referred to me because they're under notice of default, and they're asking me if I could short sell. I'm like, God, I can't believe there's a short sale already, because like house values are so high. You know, how could it be a short sale? So anyways, he bought it for like, I don't know, like $120,000, like in 1997. And he got an FHA loan for like $124,000. And then he took out a loan with Beneficial. Do you guys know, have anybody ever heard of Beneficial before? Yeah, you guys are way too young. Beneficial was one of the biggest hard money lenders out there. And what they did was, like I was telling them, I'm like, okay, so you had a loan for 125 or 124, whatever, and then you took out a loan for 13,000, and you took it out with, he first got involved with Beneficial. Then Beneficial told him over here, well, we can get you more money. You can pay, you know, we could either just pay off that one and get you more money, or we could pay off your whole loan. They paid off his whole loan and got him another loan, and then they gave him another second, and then they gave him another loan. It was on and on and on until now he owes more on his house than it's worth. Which is just, it's the saddest thing, but it's interesting because, you know, I don't know how people don't communicate with their spouses, because the wife said she had no idea he was doing what he was doing. Yet there is, you know, signing off on, you know, you can follow the paperwork. And then he said he didn't take any money out. He's telling the wife, I never refinanced a house. I'm like, and I said to both of them, I go, I don't know. I don't want to call anybody a liar. But all I'm going to tell you is, this is what shows on title, and this is how it goes, and this is the chain of title. That's what we have, a chain of title. And when you guys get a title report, and I offered to do a title report, it's like, no, we don't need one now. Well, that's because he realized he's the one who took all the money out of the house.
Oh, wow.
So, and the wife didn't know it. She probably didn't even know what she was signing when she was signing over the it's called a quit claim. And the quit claim lets him go ahead and get any, as like he can take a loan out as a single man as sole and separate property. I mean, I'm sorry. If you're married, you can do a married man as sole and separate property and just have the wife sign a quit claim, and he could refinance and take cash out. Okay, but you have to do it every time. So it's crazy, and you know, you don't know the person you're married to until you find out, right? Well, maybe that's why they're going through the divorce, right? I'm sorry, that was mean, right? Anyway, so we already did all those, the demand clauses. HOEPA also imposes highlight income verification provisions, which requires the lender to compile a written income verification and create a written record of ratios such as debt to income and cash flow. Highlight that, debt to income and cash flow. We're on the last page of chapter 3. The MARS rule. We already talked about the MARS rule, right? I was pretty detailed about it. Remember the family that had the attorney try to help him get a modification and told him not to talk to him? So the most important part about the MARS rule is highlight the ban on getting paid or collecting a fee until they have a written agreement with their lender. Highlight, require that the mortgage relief company disclose key information to consumers. Highlight, prohibition against making any false or misleading claims about the mortgage relief company. And highlight, prohibition barring mortgage relief companies from advising consumers to discontinue communication with their lenders. Yay, we made it to the end. Let's go on. All right, chapter 3, which will trigger the required disclosure of the Truth in Lending Act if included in an advertisement for credit. D, we're looking for a number, only 10% down. B, it's actually B, wait, it's not B.
D. Yeah, it is B. Easy monthly payment.
Should be D. Because you're looking for a percentage. If you go, let's go in the back of the book. Chapter 3 quiz. It should be D. It should be D. It's wrong on the PowerPoint. D is in dog because there's a number. Got it? Might be different. Number 2. If any triggering terms are used in an ad, which fact is exempt from the disclosure requirement? There's 3 things that go together, right?
The D again.
The answer is D, total closing costs. Number 3. If a real estate agent, Renee, accepts flyers from a mortgage company containing marketing information about her and the MLO and distributes the flyer at an open house, who gets busted?
Both.
Thank you. Both. Section 8 says you can't do that. Number 4. The Civil Rights Act of 1866 prohibits what type of discrimination in property transactions?
B. Race.
B. Race. Number 5. When an MLO when is an MLO exempt from the policies of the it says from the policies of the Federal Civil Rights Act? When are they exempt? The answer is never. Did you guys work today? I'm just asking because it seems like everybody's kind of asleep. The Fair Housing Act prohibits discrimination based on race, color, religion, sex, and what else?
Disability.
Yeah, disability. There's 2 of them that say disability. There's 3 of them that say, they all say disability. What are the ones?
Handicap.
Family status. C, disability, handicap, family status, or national origin. Number 7, mortgage fraud can be committed by any party to the mortgage transaction. A. Number 8, in order to ensure the loan closes, a mortgage loan originator conceals the fact that the down payment is made with borrowed funds. This would be considered A, actual fraud. Busted. Number 9, which situation does not involve a straw buyer? It's going to take you a minute to read them. You guys, it should stick out like a sore thumb. C as in cat. Lisa revises her pay stub. That's not a straw buyer, that's fraud by the borrower. Number 10, which situation is least likely to be an example of predatory lending? Subprime loan because he's out of a bankruptcy, be A. Number 11, a real estate agent believes that his client from Kenya would probably prefer to live in a less diverse neighborhood, and so he only shows the client homes that are in higher concentrated residents from Africa. This agent is guilty of? Thank you, steering. Next page. The act of redlining may be defined as C, refusing to make loans on property in certain neighborhoods for discriminatory reasons. C as in cat. Number 13, inducing owners to sell their home by suggesting that the neighborhood's ethnic composition, thank you, is changing and the property values are going to decline is, she says, A, block busting. Busting the block. I always think of Jenny Lopez on that because she was Jenny at the block, right? Which of the following, which is least likely to be a red flag, of illegal flipping schemes. Least likely. C, purchasing and remodeling a home and selling it for a quick profit. You can do that. But be careful, that one that one of my real estate agents just had, the guy bought it. He bought it for like he bought it for $750. It looks like he only put in maybe 50 grand. And he was selling it for, he had it listed at like $936, but the buyer was aggressive, so she went in at $1,070,000. And she did her inspections and found cracked slabs and foundation and all kinds of really bad stuff. And so the agent that I helped with the loans, I said, did you ask him if he did a home inspection? And see, there's your other catch-22, you know, do you want to be a good flipper or do you want to be a not so good flipper? Because a really good flipper will do home inspections and find everything that's wrong with the house and fix it. Yeah, it's going to cost more, but then their name's going to get out there. Like there's certain flippers, there's a particular flipper that it's super crazy how the world is so small. I was showing his houses, and after I showed like 5 of them, I noticed that the same guy was the same one that instead of replacing the bathtub or the shower, what he did was, you know how the fiberglass ones are like that, they get like kind of an ugly color? Yeah, he would paint them instead of replacing it and putting in new tile. And sometimes they weren't painted very good, like you'd see the drips in it.
Oh, wow.
And so once I saw his name on a house, I stopped showing them because I knew what a shoddy job he did. And if he did that on the outside that I could see, what did he do, or if anything,
Nothing.
to the rest of the house? So to me, I mean, when my lady was flipping with me, because I had an investor and I did all her flipping with her, we did the home inspection first. Now the catch-22 is you do a home inspection and you find something, now you got to either fix it or disclose it. But then, you know, if you make a bunch of money on it, you don't have to worry about somebody coming back and suing you either. So, you know, I think always doing the right thing is always going to be better way around. So, you know, flippers doing wrong things, all I can say. So going down to the last one, number 15. XYZ Mortgage makes a loan to Jill even though she's unlikely to be able to repay it, anticipating that they'll eventually foreclose on the property and obtain her equity. This is an example of predatory lending. Going on. Mortgage loan origination process. Now, I used to go through this really fast because I thought it was kind of stupid because it's kind of obvious, but it's not obvious to new people, right? So I'm going to go through it kind of slow because the guy that was having a problem passing the test, he had a problem on the loan origination process, and he helped me go through this chapter and highlighted things that I really needed to say. And we went through the chapter together, and he studied it with me, and he passed finally. So it was like, thank you, God, he finally passed.
It's a 5th or a 6th try?
On his 5th try.
Oh.
He passed on his 5th try. All right, so let's go slow on this one. I know it's going to take more time, but it's better for you. And it's harder stuff that if you guys have questions, you can ask me. Whether, because the stuff at the end is the SAFE Act, and that stuff is easy reading. Where did my thing go? Where'd it go? Because there are questions on the SAFE Act. Why did I get 3? Don't want 3. I want 4. Oh, this is special. Which one is it? Wait, do you guys see it? It should say
And that's this one.
MLO Crash Course number 10. MLO Course 10 book Crash Course 9th. Oh man.
It's on the top.
Is it this one?
Go up. Yeah.
Lord have mercy on me, right? There we go. All right. Yay. Shoo. You guys all see it, right? All right. So, initial stages of the loan qualifications. A mortgage loan originator or lender or broker, referred to as the MLO, plays a vital role in the loan origination process and often makes the crucial decisions of whether to approve the initial loan application at the beginning of financing. So your client's going to come to you and they're going to talk to you and you're going to say, okay, how much money do you make? Do you have a down payment? How much debt do you have? How's your credit? You're going to ask them these potential, these questions. And once you know, I mean, the first question I always ask is, how's your credit? Because the credit's the one thing that you can't work around, okay? If your credit score is low, your credit score is low, and you've got to, work at fixing it. One of the best ways to fix it, of course, is to pay down your debt. You know, if you have stuff that is late or slow pays, that doesn't help at all. So you're gonna have problems. You may have to go hard money, or you may have to go subprime. And if that's the case, then you're gonna have to save up a down payment. However, FHA does let you go down to 580. Technically, they let you go all the way down to 500 if you put down a big down payment. However, if you put down a big down payment, you get down to 500 on FHA. You know, you have to have compensating factors, so it's not just that. So I would always say 580 or higher, okay? And if they have a 580 or higher, then I'm going to ask them, do you have a down payment? And then I'm going to ask about their income and their debt. And then if they get past that initial thing, then they move on to getting a loan application. So the loan inquiry is that they're inquiring about a loan. Drop down to the second paragraph. When an MLO receives an inquiry related to a mortgage loan interest rate, the corresponding highlight annual percentage rate must be provided. So when you talk to somebody and you tell them the interest rate, you also have to give them the APR. The APR is always going to be slightly higher because it includes the cost of the loan. Prequalification is the process of highlight predetermining how much the highlight potential borrower might be eligible to borrow. This may be done by any MLO, but it does not guarantee an approval. Pre-qualification of the borrower is not binding on the MLO. All we're going to say is this is what I think you can do, and we should move forward to an application. The pre-qualification process involves asking the prospective borrower's question about highlight their income and their debt. For an MLO, it may be as simple as making sure that the borrower has a steady job and no glaring credit report problems. For example, no recent bankruptcies. The MLO may order a credit report or ask simple questions. I always ask my clients, I go, on a scale from 1 to 10. Scale from 1 to 10, what do you think your credit is? And if they say anything below like a 7, I'm like, okay, so what do you think's wrong with your credit? And then we talk about their credit for a while. And then I give them the options. I mean, if their credit's bad, then we're going to talk about FHA. If their credit's good, then we're going to talk about conventional. Okay? The MLO may order the credit report or ask simple questions about the financial situation. Often an MLO will compute the borrower's income and debt ratios to get an idea of the maximum mortgage loan they qualify for. So when you're first talking to them, honestly, you ask about the credit and then you calculate out what they qualify for by their income and their debt. That's just a pre-qual. So you're telling them based on your income and your debt, and you can either run their credit report or not. It's up to you. I mean, it's up to you and them. I mean, you're talking to them. They may not want you to run the credit yet. Like some people have really good credit. They're like, well, I know my credit's really good. And I say, well, if it's really good, what do you think the score is? Realize that the score that you guys are seeing online, you know, when you do your Experian check or whatever, Credit Karma, that's not going to be the same score as your mortgage loan. So mortgage loans and car loans also have different credit scores. So depending what you're running the score for will depend on what the score comes out at. Okay. So a pre-approval is just talking to them and seeing what they qualify for. I mean, a pre-qual. The pre-approval is when you actually run credit and you actually put it through the underwriting. Okay. So the pre-approval is the process which the MLO determines the potential borrower can receive financing through the lender's entity and for what amount. The lender through underwriting is rendering highlight a credit decision. The credit decision is on the borrower only. We don't have a property yet. Once we get the property, we'll run the appraisal and get the final approval. So for a pre-approval, the borrower goes through most of the same steps as a full loan approval, such as completing an application and providing documentation of income and assets. With a pre-approval decision, the loan application is evaluated based on highlight qualifying standards, such as housing expense and debt to income ratios. Additional tools may be used to evaluate the borrower's highlight credit worthiness. The lender is stating that the prospective borrower's situation has been investigated and provided the circumstances highlight stayed the same, the lender is willing to do the loan. So once you pre-approve somebody, you're telling them that we can do the loan based on the information you gave me and based on the documentation you gave me. But if anything changes, like maybe they switch jobs or maybe they lose their job, then something's going to change and we're going to have to see what they qualify for. Of course, the borrower's situation can change and sometimes does, which is why there's always a condition list on a pre-approval. It goes on to say, depending upon the pre-approval procedures, some pre-approvals are meant to be specific about the condition than others. Pre-approvals are highlight always in writing. A request for a pre-approval is not considered a loan application since the highlight actual property and loan amount has not been applied for yet. So you have to wait till you find the property because you need to know the exact purchase price. Qualifying ratios. So remember on conventional, the qualifying ratios? So as mentioned, when MLOs first meet a potential borrower, either for a pre-qualification or a pre-approval, you guys, you might as well just do the pre-approval, honestly, because this is how it works. What happens is we talk to them about their information, then we run their credit. The credit auto-populates onto your system. So most of us use Point or Encompass. Some people use one called Lending Pad. So whatever system you're using, it will allow you to press a button and order the credit. Once the credit comes in, which is like 15 seconds, it will auto-populate onto your system. And then what your job is to do is to take out the duplicates, because your credit report's gonna be, it's called a tri-merge. So it has TransUnion, Equifax, and TRW, I believe, right? Equifax, whatever. It has the three big ones. So it has the three big ones. It auto-populates onto your credit report, but sometimes they become duplicates. So our job as loan officers is after we go ahead and we input it, so we input it in, what happens is we have to take out the ones that are duplicates, and then once we do that, we make sure everything's right. We press a button, and literally, well, it depends what kind of system you have. If you're using Lending Pad, you press a button, in 15 seconds, you get what's called Desktop Underwriter. But if you're using Encompass or Point, you have to export it into the Fannie Mae website. And then once it receives it there, then you do the pre-approval there, and then you put it back into your system. So either way, it takes maybe an extra 10, 15 minutes to get the full pre-approval. So why waste your time just doing a pre-qual? Because I'd rather say to somebody, you know what, it looks like you can go forward. Do you have time to do a full pre-approval? Because once they have the pre-approval, they can go shopping, okay? And then once you get the property, you just input the property in and get the appraisal. So qualifying ratios. As mentioned, when MLOs first meet with a potential borrower, either for a pre-qual or pre-approval, to perform an analysis of their current or allowable monthly expenses based on the potential borrower's income and debt. This provides the MLO and the borrower with a realistic understanding of highlight their mortgage payment the borrower will afford. There are two qualifying standards. Highlight the housing expense ratio, and at the top of the page, highlight the debt to income ratio. Aside from the gross income, the key element needed to determine the ratios is highlight the PITI. This is an acronym for highlight principal, interest, taxes, insurance. When the collateral property requires an association fee, the association is inside the housing expenses, okay, on the top end. Housing expense ratio. The housing expense ratio is the relationship of the borrower's gross monthly income to their total monthly housing expenses. So I'm going to go slow here because you guys have to know how to do this. Okay. Total housing expenses equals a percentage. Conventional lenders highlight conventional lenders. Consider the borrower's income adequate for the loan if the proposed total mortgage payment, highlight PITI, does not exceed 28%, and circle it. So Mary has a suitable income of $2,900 a month. She wants to buy a house with a total payment of $700. Take the $700, divide it into the $2,900, it's 24%, so she qualifies because she's under 28%. The total debt to income ratio, well, now you're gonna add any debt they have monthly. So unfortunately, Mary has more stuff. So it says conventional lenders want, highlight 36%. So technically, for the purpose of the test, it's 28 over 36. Okay, so now you're gonna take the house payment plus the car payment plus the child support, and you're gonna get $1,025. You can divide it into the 2,900 and you get 35%. So that one qualifies also because you can go to 36%. Is everybody good on that math?
Yeah.
Okay, if you have a problem with that math, you could always text me, like get on the practice questions or go over the practice questions, see if you need help, let me know. Top of page 85. The borrower's total debt to income ratio is an example as 35%, which is acceptable because we're allowed to go to 36. It says for the purpose of the test, when the underwriter considers both ratios, you need to qualify under both ratios to qualify. In the real world, that's not true, but on the test, you have to have the 28 over 36. Okay? Going on. To determine the maximum mortgage payment. So the housing expense ratio and the debt to income ratio can be used to determine the maximum mortgage payment for which the borrower can qualify. To determine the maximum mortgage payment, this is the easiest way you guys can do it, okay? Payment allowed under the first ratio, take the borrower's stable monthly income and multiply it by the housing expense ratio. So you ask them how much money they make per month, you multiply it by 28%, and that's what you should have for the house payment on the front. Mary Smith has a stable monthly income of $3,200. She has 3 long-term debts, 220 car payment, $75 personal loan, and $50 revolving charge payment. The housing expense ratio is 28%. So take her 3,200, multiply it by the 28%, and you get 896. You guys see that? 896. Okay. Then you take the total debt to income ratio, 36, and you take her income, 3,200 times 36, and you get 1,152. Then all you do is subtract out the monthly debts, and you get 807. So the maximum house payment she qualifies for is the 807, not the 896, the lower of the two. Okay? Make sure you take the lower of the two. Go to top of page 85. Program qualifying standards. So highlight conventional housing expense, 28. Highlight conventional debt to income, 36. Go down to FHA qualifying standards. Highlight FHA housing expense, 31. Highlight debt to income, 43. VA standards. VA does not have a front and a back. They only have a back. And it says 1, 2, 3, 4 lines down. VA does not apply to housing expense ratio as a qualifying component, but does look at the highlight residual income. So residual income is the amount of money left over after all expenses are paid, which is the amount of income a borrower has left after subtracting taxes, housing, and reoccurring debt obligations. The VA has a regional guideline to estimate the average cost of utilities based on the size of the house. Those costs are included as part of the debt obligation. A veteran's residual income must meet the VA's minimum requirement, which is available from the VA. The VA allows a maximum debt to income ratio of highlight 41%. Next page. Discussing and identifying potential loan situations. So you guys, every loan's different. So you have to figure out what's best for your client. That's the main thing. So it says, as part of the initial conversation with the potential borrower, the MLO needs to ask questions to determine the type of mortgage that's best to meet the financing needs of the potential borrower. Traditional conventional loan with a fixed rate, or do they want an adjustable rate? Origination process. The steps to a final loan decision can be, I can't even talk anymore, can begin with the MLO with highlight a complete application. So after you talk to them, you're going to do an application. That includes highlight the property address and a signed purchase agreement. And all of the required disclosures have been made. Okay, so remember, this is how it happens. So first of all, one of the things that you guys need to know if you're working with buyers is the new purchase contract that's 16 pages. Inside that purchase contract, it gives both realtors on both sides the right to call the loan officer and an authorization from the buyer to let them release information. So I don't think a lot of loan officers know that yet, because one of the ones that I'm helping the real estate agent with, even though she's getting her loan through a credit union, and the real estate agent called the credit union because the appraisal came in and asked about it, and he's like, I don't have to give you the appraisal amount because I'm going to give it to the buyer and you can get it from her. And it's like, I guess he doesn't know the terms of the new purchase contract, because it literally says you're authorized to release the information. So you guys have to, you're already authorized. You don't have to ask them to do it. And you might even want to tell your buyer when you're talking to them, I just want to let you know, if you didn't read your whole purchase contract, on the purchase contract, it does authorize me to release information to to the listing agent. And it's mainly for those times where the real estate agent is trying to get a hold of the loan officer, and they're trying to get a hold of the loan, and the loan officer is avoiding them, or the loan officer is not answering any questions, or the real estate agent or the borrower is not answering questions. So finally, the real estate agent has no choice but to go straight to the loan officer. So we have to release the information. It says so in the contract. Okay. So when you first originate it, you're going to sit down, you're going to take a completed application, you're going to have the purchase contract. You have to know that the loan application is called the URLA. We talked about that already once, the Uniform Loan Application. It's going to be on the next part. You can just highlight it, so we'll get that there. So under the purchase contract, a signed purchase agreement is a document that's likely to provide the MLO with the final pieces of information needed to complete the mortgage loan. When the goal is an actual loan approval, not just a pre-approval, the purchase agreement needs to be examined by the MLO. You guys got to look at the time frames. Look at the dates, how fast you have to close this thing. It's the buyer's initial offer and the subsequent counteroffer. It's the receipt for the earnest money deposit. You need that for underwriting, so highlight that. That receipt of earnest money deposit, you're going to have to put that in your package before you send it in for final approval. It's the contract between the buyer and the seller. Underwriter's going to see that. It establishes the terms and conditions of the sale. It's the document that communicates the details of the transaction to the mortgage lender, title company, and other parties. The MLO needs to ensure that it is possible to comply with the terms of the agreement. A particular concern is highlight the financing commitment date and/or highlight closing date. An agreement may call for the closing date that's too early or to be realistic. If it's impossible for the lender to meet the closing date, a more feasible date should be agreed on by all parties to the agreement. So like right when you first see it, if it's like a 10-day closing, you're going to be like, there is no way we can do a 10-day closing. So make sure that you look at the contract and know the closing date. Next thing is uniform loan application. This is where it says it. Highlight uniform residential loan application. Literally, that's one of the questions on the test. What does URLA stand for? Okay. Fannie Mae and Freddie Mac. Fannie Mae's form is 1003. Freddie Mac's form is 65, but they are identical. At the bottom of the page, it says Fannie Mae 1003 and Freddie Mac 65. Is the form that the lender requires all borrowers to complete. An application may be in writing or it can be electronically submitted, including a written record or an oral application. The borrower typically completes the loan application during the initial consultation with the MLO. There's a great deal of information asked, therefore attention to detail when completing the application is advised. So that's why we did the, we were doing a class called Mortgage 101, but we changed it to one understanding the mortgage process. And we go through the whole loan application slower than the 20-hour class because you have to know what you're looking for. And the more information on your application, the more the underwriter is going to understand about your file. Okay. As of March 1st, 2021, you might want to highlight that. We had to start using the new application. So the redesigned URLA must be used. The URLA has highlight 5 separate forms, all or part of which may be utilized depending upon the situation. There are 5 forms included. You should know these 5 forms. So they might ask you, all of the following are forms on the new application except borrower's information, additional borrower information, unmarried addendum, lender loan information, continuation sheet. In all cases, the lender loan information form is completed and the continuation sheet is used by the URLA. Borrower information does not have significant space for the information provided. If you want to review instructions for completing, you can go to the Fannie Mae website and it shows you how to complete the application. You do not need to do that before you go and take the test. Okay. Electronic signatures, we talked about that before. Electronic signatures in Global and National Commerce Act regulates the use of electronic signatures and records in interstate and foreign commerce. A party to a contract at the top of 87 cannot be forced to use the electronic signatures and may sign with ink. That's called highlight a wet signature. One party can use the electronic signature method while the other parties retain the right to sign their loan documents. It says a consumer must receive disclosure information regarding their right to have highlight a legible copy of the document, disclosing when consent applies, describing procedures to implement and withdraw permission for electronic signatures highlight withdraw permission. So if somebody says, I don't want to do it electronically anymore, it's too easy for somebody to sign for me, then you can say I withdraw. And once you withdraw, you do all wet signatures from that time. Anything prior to that was done electronically is still valid. If a statute, rule, or regulation requires that a contract or other record has to be contains electronic signatures, or the authorization to sign electronically requires a retention period, that condition must be met with the retention of the electronic record of the information in the contract. It must maintain accessible to all parties who are entitled to have it by law. A person who can withdraw his signature or consent electronic signature highlight at any time. And going on, completed application. So you have to know the 6 items. So the 6 items that are a completed application. So even though we have a 16-page or a 19-page application, if you have these 6 items, that's a complete application, and you have to send out disclosures. So highlight or know these: name of borrower's social security number, gross monthly income, amount of the loan, address of the property, and value of the property. Top of page 87. As set forth by the Truth in Lending Act, highlight within 3 business days of getting those 6 items, you must send out 3 items, the first 3, loan estimate, home loan toolkit, and a list of counselors. Next to the list of counselors, the question could be, how many counselors have to be on that list? The answer is 10. So you might want to write that in. 10 on the list of counselors. A list of settlement service providers which the lender permits the consumer to shop for. So the list of settlement service providers has to go out within 3 days, but does not necessarily have to go out in the same packet with the loan estimate, the home loan toolkit, and the list of counselors. Okay. Additionally, for a home equity line of credit, highlight when your home is on the line must be provided. For adjustable rate mortgages, highlight the charm booklet. And if you own an affiliate who they're planning to use, you must highlight the affiliate business arrangement by the lender at or within 3 days of the application. These disclosures must be delivered by the borrower within, highlight 3 business days. It's always business days. You guys pound that in your head, because I had one student tell me, if you didn't keep pounding the word business days in my head, he's like, they try to confuse you. I'm like, yeah, that's the whole point of the test. They try to confuse you. It's not fair, but they try to. So they may say work days, they may say calendar days, they may just say 3 days. The answer is always going to be business days, okay? Make sure you know that. Okay, so 3 business days. So within 3 business days of the receipt of a completed application, or placed in the mail within 3 business days of the receipt of a completed application. An MLO may not obtain a credit card number, so don't ask them for their credit card number. And you cannot ask for any money except for the reasonable amount of a credit card, a credit for the credit report, okay? So that's somewhere around 35 bucks. It says Regulation Z permits the MLO and services from charging a fee for the preparation of a loan estimate or other disclosures. So you cannot charge anything for disclosures. Just because you gave them disclosures and you worked on the file doesn't mean you're about to get paid, okay? Application and verification and documentation. The MLO and loan processor work together to gather pertinent information to validate the borrower's income and asset information as provided on the application. Depending on the employer, the role of the MLO and the loan processor may differ in gathering verification documents. So you're going to get from your client a month of pay stubs, 2 years W-2s, and 2 months of bank statements, all pages, front and back. You cannot get these items until your client says they intend to move forward. So you're going to get 6 items. You're going to send out 3 disclosures. They're going to say they intend to go forward, and then you're going to get their money, and you're going to get these items. Got it? Next page. Verification forms. Since the borrower, employee, bank, or credit union, and any previous mortgages. So if they have a mortgage and they're selling a house, you're going to get their mortgage verification. If they're a first-time buyer, obviously you won't get that. If they're refinancing, you're going to get their mortgage coupon also. Caution. A borrower cannot be required to provide income documentation as a condition for providing a loan estimate. However, a borrower can volunteer the information. Once the application, I've never seen that before. Once the application disclosures have been delivered, income documentation can be required. Oh, that's a good one. So you might want to keep that in mind because you might get a crazy question like that. It says, so let's just look at that real close because it says the borrower cannot be required to provide income documentation as a condition for providing the loan estimate, the first three disclosures. However, a borrower can volunteer the information. So make sure you know that I'd highlight that because they might ask you that question. Once application disclosures have been delivered, income documentation can be required. Loan processor's role. So basically, kind of keep it in your head that the loan officer is licensed and has to supervise the processor for the purpose of the test. The loan processor is the one that's verifying everything that is on your application is correct, okay? The loan processor's role is to verify everything's correct. After the MLO is satisfied with all the loan application is complete with the needed documents and has been done to strengthen the quality of the application for the loan decision, it's passed to the loan processor. The processor has responsibility for preparing and organizing the loan file and works as a liaison between the key players in the loan decision. More specifically, the loan processor double checks everything provided by the MLO, including highlight debt to income ratios, employment information, and work with the MLO to ensure the file is complete before sending it to underwriting. So on the debt to income thing, I mean, sometimes you guys will come in with the right debt to income ratios, and then you'll go into the office and your processor will look at you and they're like, hey, I'm getting these ratios. And so then you got to kind of go back and forth with your processor until you guys, make a decision what debt to income ratios you're going to go in, because sometimes your processor will find the income different than you do. And that will happen depending on your client's situation. And then sometimes it's even more frustrating because I'll get an income, my processor will get a different income, and then the underwriter will throw something else at us and we're like, what? So make sure you understand your client's income, okay? And work with your processor on it. Work with the credit bureau companies to repair credit that is incorrectly reflected on the credit bureau. Package and submit the loan file to underwriting, so the processor packages to underwriting. Work with the MLO, title, and escrow companies and underwriter to fulfill the conditions that the underwriter has stipulated must be met before the loan approval with a clear to close status. So the processor is going to be the one telling you, the loan officer, what to go get when you're doing I call it the scavenger hunt. I like to do all my stuff up front, and you should do everything up front so that you have less conditions. When you get a loan approval back with a bunch of conditions, it just looks like, oh God, look at all the stuff we have to get. But if you do your file right and it's a clean file, you'll have less conditions and less scavenger hunting, right? Title search. So the title search is the actual lawful owner. Title is the actual lawful ownership of real property and refers to the highlight holding a bundle of rights. Evidence of title must be provided by the seller at the closing to prove that he has marketable title, which means that the title is highlight free and clear from undisclosed encumbrances or any defects that would impose the purchaser to litigation or impede a purchaser's ability to enjoy the property or sell it at a later date. The title company is responsible for highlight examining and researching the title of the property. Top of the page. Make sure I get that there. I don't have appraiser yet. Property inspection reports may be part of the purchase agreement, and there's a number of inspections that the lender may require beyond the purchase contracts. Okay, let me explain something. The lender almost never requires any additional inspections. The only time the lender is going to ask for additional inspections is if the appraiser goes out there and, like the one that it's not mine, thank God, like the one that just happened, the appraiser noted that there was cracks in the foundation, and that the windows and doors didn't close correctly. So he noted that and said that there should be a foundation inspection. And so when you start getting to foundation inspections and hiring soils engineers, that starts to get expensive. But the only time the lender's going to ask you to do that is if it's noted on the appraisal. So as a lender, I have never seen anything ordered that was not in the purchase contract, okay? And usually what's going to be normal in the purchase contract will be pest inspection, termite reports, and home inspection. And as a major rule, we don't look at the home inspection. We never see the home inspection. We do see a clear, if a contract has a termite inspection in it, then we want a clear termite inspection, okay? But if there's no termite inspection in there, we're not going to ask for one unless the appraiser notes it. So everybody thinks that no matter what, when they buy a house, they get a termite inspection. Well, that's not true. So we don't need a termite inspection on a conventional loan, only on FHA and VA government loans, okay? So inspections. Property inspection reports may be part of the purchase contract, and there may be a number of inspections the lender may require beyond what the purchase contract requires. The property inspection is geared towards finding items that are dangerous, highlight that are dangerous items that may damage or items that don't work. Oftentimes, real estate licensees will play an important role in helping clients obtain the needed inspections, getting agreements that issues will be resolved, and ensuring issues are resolved before closing. Different types of mortgage loans, FHA, conventional VA, require specific property conditions must be met. The loan processor typically will wait to order the appraisal until after the initial property inspection is completed, and any items the borrower wants resolved are formally added to signed purchase agreement. Okay. In this market, we're not ordering we're ordering the appraisal right away. So, I like to wait until the buyer's ready to go, like the book says. Wait until the inspection is done. Wait till they know for sure they're moving forward before you order the appraisal. Well, with the real estate agents saying that we can close in 21 days, what's happening is they're super pushy. And so, unfortunately, but true, some people don't want to listen to me. No, I'm just kidding. Because what I like to do is I like to make sure the appraisals, the home inspections are done and the buyer's ready to go forward before you do the appraisal. Because appraisals used to only be $250, maybe $300. Now they're anywhere from $550 to $750. So this young lady, I was not her loan officer. I was her loan officer, but she went to a credit union, and the credit union, he was in a big hurry to get everything done. So he got her paperwork and he ordered her appraisal, and her appraisal was $950. And her appraisal was $950. She did a home inspection. There was a bunch of things wrong with it. She had a bad feeling about it. She didn't want to move forward. Then the appraisal came in at $75,000 lower than they thought it was going to come in at. So she spent like a ton of money, and now she dropped out of escrow. So I think if she would have done the appraisal and found, because she bought it for $1,070,000 and the appraisal came in at $925,000. They thought it was going to appraise at $975,000. At $975,000, she was going to bring it almost $100,000 over. She wasn't happy about bringing over $150,000 over. So, in the book it says you're going to wait till after the inspections. So for the purpose of the test, you will wait till after inspections to order the appraisal. But in the real world, those real estate agents want that thing ordered the second you can order it, which is at about 4 days, okay? Property appraisal, here it comes. The loan processor requests an appraisal of the property being purchased. An appraisal is highlight the opinion of the property's most highlight probable selling price. Opinion, probable selling price. It's not a fact. It's the opinion of the appraiser. It's only an estimate or an opinion, is not a guarantee. It's only valid as of its highlight effective date, which establishes the terms, conditions, and economic circumstances upon the value is estimated. An approved appraisal management company, they're called AMCs. So if you can't remember that, highlight approved appraisal management company, AMC, were initially mandated, highlight mandated by the Federal Deposit Insurance Corporation, highlight 2011. Authority and enforcement of the AMCs were highlight assumed by the CFPB. The standard calls for the independence of appraisers, including communicating with the appraisal firm and placing the order for the appraisal for the property appraisal. Highlight MLOs cannot directly contact the appraiser or place an appraisal order. By using the appraisal management company, appraisers will have no relationship with those who are a part of the transaction and can provide an unbiased appraisal opinion. Highlight Uniform Residential Appraisal Report, that's the URAR. Is the form standard appraisal report used for the lenders for an appraisal? That's all you need to know there. Go up to loan underwriting. Once the file has been handed off to the underwriter will work to highlight the degree of risk a loan represents and make a loan decision based on the highlight level of risk. Understand that the MLO and the loan processor will still play a significant role with this step of the loan process as they continue to work with the borrower and the underwriter. So once the underwriter starts working on it and they give you a list of conditions, you're going to go back and forth with the underwriting. And it's interesting because when you get conditions, like the underwriter gives you conditions, you can't piecemeal them. Like if you have 12 conditions, okay, you give all 12 conditions that are exactly what she's asking for at the same time. Because your conditions just don't go straight to the underwriter and she signs them off within seconds. It gets in line and she has a line, like normally the underwriters will be underwriting in the morning or going over conditions in the morning, either or. Whatever they're doing, if they're going over conditions, they're not going to be underwriting. Okay, so the fact of the matter is people always go, oh, well, we got all the conditions in this morning. And they think that, okay, well, in 10 minutes, we're going to have them all signed off. We're not. You have to get in line. Okay, you're not the only one. So make sure people know that it usually takes 24 to 48 hours to get the underwriting conditions signed off. And then once the conditions are signed off, then they'll give you the clear to close. Okay, going on. So the underwriting process usually begins with a decision through highlight an automated underwriting system. The automated underwriting systems are important because they speed up the process. A mortgage loan applicant is typically submitted for evaluation and decision through the automated underwriting systems they call an AUS. The purpose of the automated underwriting system is highlight to reduce the cost of examining a loan application and highlight speed up the mortgage application. That's the answer when they ask you, why do we have automated underwriting? An automated underwriting can provide consistent underwriting decisions using statistical computer models based on traditional underwriting factors, and highlight never considers factors such as race, ethnicity, age, or any other characteristics prohibited by law. With a large database of statistics and information available, the secondary market has increased efforts to manage credit risks by improving loan criteria. Both Fannie Mae and Freddie Mac have automated underwriting systems. Fannie Mae uses highlight 2 automated underwriting systems, highlight desktop originator for brokers and desktop underwriters for the lenders. Freddie Mac uses highlight loan product advisor. Y'all with me? The automated underwriting system makes a recommendation to accept the loan for delivery or refers it to an underwriter for further manual review. Even with an automated approval, an underwriter still must validate the information entered into the system. So the underwriter is going to look they're going to look at the application. They're going to make sure everything's the same in the application that was inputted in the point system and everything matches. Okay. So they have to verify everything. So basically the underwriter is the super verifier. So the processor verifies what the loan officer brought in, and the underwriter verifies what the processor brought in. You got that? So even though you put it in, because people can manipulate the automated underwriting system, so they have to verify that you put in what you actually have. While lenders may rely on the automated underwriting system for preliminary decision, it generally comes down to highlight a human underwriter to make the final decision. Underwriter's loan review. When evaluating a loan file, the primary concern throughout the underwriting process is highlight the degree of risk the loan presents. The underwriter attempts to answer fundamental questions. Is there highlight significant value in the property pledged as collateral? Is it a highlight marketable property title? Does that mean the property is clear and free of any encumbrances? Are items regarding the real property considered, such as highlight flood zones, highlight environmental issues, and local, municipal, and regulatory issues? Does the borrower's overall financial situation, which is comprised of credit, income, assets, indicate a reasonable expectation of making the proposed monthly payment? More specifically, when evaluating the mortgage loan, the underwriter goes by these highlight 4 C's. You have to know what they are because you're going to ask. All of the following are part of the 4 C's, except, and you need to know what the 4 C's are. Highlight collateral, which evaluates the value of the home. Highlight credit history, which is the history of the borrower. Highlight capacity to repay the loan. Is the borrower able to make the payments? And cash assets, if there's any more money left over after they close. It's important for MLOs and loan processors to understand underwriters' evaluation process to better provide the documentation within the loan file that will allow the underwriter to render a correct decision. Evaluating collateral. So this is more like the appraisal process. So collateral for a mortgage loan is typically property secured by the loan. Underwriters highlight the loan to value to determine how much they're willing to loan on a given property based on its value. Recall, loan to value is calculated by the loan amount or the sales price, whichever is lower, appraised value. By the appraised value equals the loan to value. Next page. For example, the sales price of a property is $165,500 and buyer Ellen wants to borrow $125,000. The property is appraised at $155,000. And the lender requires 80% conventional loan to value. The loan to value is calculated 120 divided by 155 equals 77%. So it's under 80%. So there's no mortgage insurance. Remember that loan to value is calculated on the lower of the sales price or appraised value. The lender would make the loan to Ellen on the loan to value because it's below 80%. Different loan programs require different loan to values or highlight CLTVs. Okay, the CLTV is the combined loan to value, which we'll look at in a bit, I think. Or we already, yeah, we'll see. Evaluating credit history. So credit, we talked about that a little bit. Credit is the record of debt repaying, detailing how a person pays their credit amount in the past as a guide to whether they're going to pay it on time or not in the future. The underwriter analyzes the borrower's credit history through highlight a credit report. So they don't just look at the credit score, they look at the credit report to see their history. The main credit reporting companies are, here they are, highlight Experian, Equifax, and TransUnion. Oh, one of the questions is who came up, I think we already talked about that. Who came up with Fair Isaac? I gave that to you. Who came up with the FICO score? And it's Fair Isaac and Company. I gave that to you the other day. Make sure you know that. It's a question on your test. That's not in the book anywhere. Who came up with the FICO score? And it's Fair Isaac. Which is interesting because it's not in the 20-hour book, not in this book, but they want you to know it. So I don't know how you were supposed to find it out unless you had me, right? Going on. So we're on the credit history. Pardon me?
It's actually mentioned on page 90 on the right side.
Does it say, oh, on the right side? Oh, yeah, you're right. Well, it wasn't in our other book, okay? They must have just, they added this one in. This is the first time it's been in the Crown Course. But thank you. All right, we'll highlight it when we get there. So it goes on to say, thank you. If the credit history shows slow pay record or other derogatory credit information like a lawsuit or a judgment, repossession, foreclosure, a loan applicant can be declined or the borrower can put into highlight a high risk. In some cases, derogatory credit or credit history or rating does not prevent the borrower from obtaining a loan if the credit problems highlight can be explained. The underwriter must be satisfied with the explanation. So you can't really point fingers at your creditor. I mean, if you did something wrong and you admit it, it's better than if you say, well, they did this. Even without derogatory ratings, underwriters may find other concerns in a credit report that might indicate the borrower is a marginal credit risk. If the individual's credit pattern is one of continuing increasing liabilities and periodically bailing themselves out through bill consolidations, that could be a bad thing, and refinancing might not be a good thing for them to do, and the underwriter may not want you to do it. This pattern suggests a tendency to live highlight beyond the prudent level. At the top, credit scoring. So here's where they added that. It says, I want to see what that says. Credit score. As an objective means of determining the creditworthiness of a potential borrower based on a number scoring system. The credit scores highlight a numeric representation of the borrower's credit profile. compiled by assigning specific numerical values to different aspects of the borrower's credit makeup. These numbers are adjusted to highlight up and down based on strengths and weaknesses of a particular qualification. The numbers are computed from all categories using highlight an algorithm, then assigned to a credit score. For example, a person with a large line of credit that they rarely use would likely have a higher score than somebody who maxes out their credit cards. Credit scores also play an important role in automated underwriting, since Fannie Mae and Freddie Mac have identified strong correlations between mortgage performance and credit scores. The higher score, the better the risks. The lower the score, the higher the risk. Credit scores are a result of a very complex calculation carried out by a computer that considers every aspect of the borrower's credit line. While there are many different names for the credit scoring systems, many consumers are familiar with Highlight the FICO score, which was developed by Highlight Fair Isaac and Company. So that's the one that's a new question on the test that is in this book. I used to just breeze over that and didn't even see that until one of my students go, hey, that was on the test. So that's what was cool about going through the whole book with somebody who went through the test a bunch of times, because I got everything highlighted I need to know. Which was developed by Fair Isaac, we said that. Other common names for credit scoring systems are Beacon, which is used by Equifax, and Empirica, which is used by TransUnion. Each of the three main credit bureaus' score is calculated a little differently. For example, now, this is what he told me, and this is what some other students have told me, is you have to know that FICO weighs payment history as 35% of your total score. Highlight amount owed as 30%, length of credit history 15%, and new credit 10%. So if you can't remember that, go ahead and highlight it and put a star by it and go over it again. Regardless of your actual calculation, all credit bureaus produce similar scores. The range is from highlight 300 to 850. The secondary market adjusts the interest rate depending on your credit score. So if you have really the higher your score, obviously the better the interest rate you get, but 740 is the score they're looking for to give you the best interest rate. However, above 720, highlight 720 is acceptable. Between highlight 620 and 720 is marginal. And highlight below 620 is high risk. Fannie Mae and Freddie Mac will not do that loan. Going on, I'm trying to figure out where they have that. Oh, they have that way over there. Trying to figure out where they have that. Okay, going on. Top of page 91. Before making decisions regarding qualifications, lenders are encouraged to check the accuracy of the credit information. Sometimes things show up on the credit report that are not supposed to be there. So you could actually look at that and you could do what's called a rapid rescore. So a rapid rescore will help us like fix the credit if it was something that was on the credit that shouldn't have been there. Credit score information disclosure. A borrower may have questions regarding their credit score. The Fair Credit Reporting Act was amended in the section code of the Fair and Accurate Credit Transaction Act, highlight of 2003, requires that a highlight notice to the home loan applicant credit score disclosure must be provided to a borrower. This disclosure must include the score that the credit reporting agency distributed to the lender used in connection with the home loan and the key factors affecting the credit score. The disclosure must include contact information. Highlight that, must include contact information for agencies used. The Fair and Accurate Credit Transaction Act allows customers to have highlight one free credit report per year from each of the national credit reporting bureaus. Experian, Equifax, and TransUnion. There's the website. The question is, what website is the one you go to for your free credit report annually? And it's annualcreditreport.com. Borrowers should be encouraged to take advantage of this. They are also entitled to a free credit report when? Okay, so on your Fair Credit Reporting Act, the first act, under the first act, if you have information on your credit report that is adverse, that you got an adverse action notice on, you get a free credit report because you're supposed to be able to look at why you have an adverse action letter. If you are highlight a victim of identity theft, if the credit file contains highlight inaccurate information because of fraud, or the consumer is on highlight public assistance. For one of those four things, you get a free credit report. Evaluating capacity. When evaluating capacity, the underwriter wants to know if the borrowers have highlight ability to repay the mortgage. In making the determination, the underwriter considers the borrower's highlight current, this is super important, current and reasonably expected income. Highlight that and circle, current and reasonably expected income. Or assets other than the value of the dwelling, including any real property attached to the dwelling that secures the loan. Top of number, page 91. Current employment status, if the creditor relies on income from the consumer's employment in determining the ability to pay. Monthly payments on the covered transaction, monthly payments on simultaneous loans that the creditor knows or has reason to know will be made. Monthly payments for mortgage-related obligations, current debt obligations, alimony and child support, monthly debt-to-income ratios, or residual income. Credit history. Underwriters use highlight third-party records to verify information that they rely on in determining repayment ability. For income, they use tax returns, W-2s, payrolls, other government agency records. For debt, they use credit reports. For assets, they use financial institution records or receipts from funds transferred or cash checking services. Employment may be verified verbally, and debts that the borrower discloses on the application that are not reflected on the credit report do not need to be verified. Debt to income ratios. In general, debt to income ratios are calculated to determine ability to repay. Highlight fixed rate loans. Here we are. Fixed rate loans use the monthly fully amortizing payment. Well, yeah, because that's the payment we have. For adjustable rate mortgages, they use highlight the fully indexed rate. They don't use the introductory rate. It says after that, it says whichever is greater. Well, the introductory rate is not going to be greater than the maximum rate. So they're going to use worst case scenario. Remember that. For loans with balloon payments, they use highlight maximum payments scheduled during the first highlight 5 years for the non-higher price mortgage loans, or maximum payment scheduled for the higher price loans. For interest only loans, they used highlight the fully indexed rate or introductory rate, whichever is greater. So you always have to take worst case scenario. And for neg-ams, they use the fully indexed rate or introductory rate, whichever is greater, and monthly principal and interest after the loan is recast. So recast means they look over the loan and they go, okay, you have to pay this in order to pay off your loan in the next 20 years. Evaluating debt. Dun dun. Hopefully we don't have a lot of debt, right? Debt is any highlight reoccurring monetary obligation that highlight cannot be canceled. Underwriters generally consider debt if it is secured or unsecured reoccurring monetary obligation that will not be canceled unless paid off. In calculating the debt to income ratios, underwriters consider existing and reoccurring long-term monthly debt as part of the borrower's obligation. For example, installment loans for cars, furniture, and the like, usually with more than highlight 10 payments remaining, are what they're going to count. Once you get to less than 10 payments, they may not count it against you. As I said, may not count it against you. Credit card and retail account payments, child support and alimony, and other mortgage loans. Additionally, highlight a car lease is considered a debt. So is a student loan and a court-ordered child support. Make sure you put a star by this one. Utilities and automobile and health insurance premiums are not considered a debt because they can, in theory, be canceled. Lenders assume borrowers would turn off their phones or cable service before they lose their homes. Gray areas include such things as doctor bills. These are generally not considered to be debt unless they have a payment schedule. If a borrower has a student loan currently in deferment, so they're not making payments on it, we still have to count it. This needs to be calculated as debt regardless how soon the loan will be repaid. Evaluating income. When evaluating income, underwriters ask these questions. Does the documentation provided in the loan file highlight verify the income reported by the borrower? Highlight what portion of the borrower's total verified earnings is acceptable. What is the borrower's highlight history of steady full-time employment? Stable monthly income, that is monthly income that can highlight reasonably be expected to continue in the future, is generally meant to include the gross base income of the borrower from their highlight primary job. The borrower can substantiate standard stable employment and income by providing W-2 forms for the previous 2 years and pay stubs for the previous 30 days. Top of the page. In determining the borrower's stable monthly income, underwriters consider the length of employment and the durability or probability of continuance of income. A quality source of income is one that highlight is reasonably reliable, such as income from an established employer, government agency, or interest-yielding account. Highlight durable sources of income are expected to continue for a highlight sustained period. Temporary unemployment benefits or newly established rental income are not likely to be counted. Durable sources of income include highlight bonuses, commission, and part-time earnings. These sources of income are considered durable if they are part of the earnings for the last 1 year. Proof of consistency can be done with the W-2s, payroll documentation, and income taxes. Overtime cannot be counted unless it's consistent. Employer verification is almost always required. So overtime has to have a 2-year history. The above, bonuses, commission, and part-time, they're saying is 1 year. Double check that with my underwriter, right? Retirement benefits. Generally, retirement benefits are considered stable income, though a source must be examined to determine solvency. Social Security payments are considered income if the borrower receives Social Security benefits. If Social Security is permanent income for the borrower who has reached retirement age, it will count. If payments are a result of highlight disability or some other condition, the underwriter will treat them as any other disability payments. Investments. An investment is considered durable if the investment is sound, interest payments have been consistent, and if the principal is not being used for the transaction. Rental income. Rental income from a property is durable if its stable pattern of positive cash flow can be verified. Alimony, child support, and separate maintenance. These sources of income are considered durable if payments are likely to be received on a consistent basis. Proof of such consistency can be shown by submitting highlight copies of a W-2 form, pay stub, or federal income tax return. Tax returns are reviewed for unreimbursed business expenses that are deducted for income. Underwriters typically require verification of employment earnings and the likelihood of highlight continuance for at least 3 years. Underwriters typically require that a completed highlight 4506T from the borrower at both application and closing. This form gives the permission to request electronic transcripts from the IRS. Evaluating assets at the top of the page. Hey, we get lunch in a few minutes. Well, not a few minutes, 20 minutes, something like that. Evaluating 15. Assets, evaluating assets. When underwriters evaluate assets, they are specifically interested in identifying if there is highlight assets needed for the required down payment and reserves. Additionally, they want to know what other assets, especially in liquid form, highlight that liquid form. You have to know the difference between liquid assets and non-liquid assets. Like if they'll say all of the following are liquid assets except. So we're going to get through those right now. Okay. Especially in liquid form, such as savings, stocks, and bonds can be used to pay unexpected bills or to support the family with a temporary interruption in income. Assets are simply items of value. The underwriter must take the necessary steps to verify the nature and value of the asset held by the borrower to ensure the borrower can close and repay the mortgage. Liquid assets are highlight cash or any other asset, such as a stock or bond, that can be highlight, circle, and highlight, quickly be converted to cash. So if you don't know which it is, think about how fast you can change it into cash. So checkings accounts, savings accounts, certificate of deposits, money market accounts, mutual accounts, stocks and bonds, retirement accounts, and trust funds Cash values of life insurance can all be cashed out relatively quick. Non-liquid assets. Cash deposits on the sales contract, which is the earnest money. Proceeds from the sale of a non-real estate asset. Proceeds from property being sold before closing. Sweat equity, employer assistance. Rent credit, secured borrowed funds. Trade equity, and unsecured borrowed funds. Top of page 93. It must be determined that the borrower has significant highlight liquid assets to make the cash down payment and pay the closing costs for other expenses. So one of the things that a processor will do is if we don't show enough money in the bank account, will be, okay, the first thing we gotta do is call the borrower and see if they have more money, if they're able to get more money, and where it's coming from, and make a paper trail. Because if we put into the system, the automated underwriting system, let's say that they need $19,000 to close, but they have $18,900, they're like $200 or $300 short to close, it's not gonna approve the file because there's not enough to close. So even if it's just by a little bit. So like the processor may, after talking to the borrower, just up it a little bit so we can get the approval and see what the conditions are, okay? Going on, it goes on to say the underwriter also wants to know the source of the money. So we have to do a paper trail where all the funds come from. Borrower's funds must be secured and the debt considered in the total debt to income ratios. Most lenders and underwriters only allow secured loan for closing to be obtained through the borrower's own highlight personal liquid assets, such as a Roth IRA or 401k. An applicant may also use gift funds. So I don't know if we talked about gift funds for FHA. I think we did.
We did.
Yep, good. So gift funds are the same way with conventional loans as our FHA. You have to get the gift letter, do the paper trail, and everybody has to sign it, okay? Gift funds include relative, drop down to the big I because they spell it out better. Relative, employer, religious nonprofit, community nonprofit, federal, state, and local agencies. But go up a paragraph or two where they have gift in big bold letters. Highlight where it says the gift has to say on it that it does not have to be repaid. This is a gift and it does not have to be repaid. Drop down to the last paragraph. Reserves are cash on deposits or other highly liquid assets a borrower will have available. Highlight after the loan funds. Underwriters would like to see at least enough to cover 2 months, highlight 2 months PITI, which is the mortgage payment, after the borrower closes and all closing costs. Next payment, but it's not required. Next page. So remember, the cash reserves are not required. They used to be, but they're not anymore. So, I mean, they could close and have almost no money to their name. I remember when FHA was like that and conventional wasn't, and we had to take a client FHA because he didn't have any money left over. And we knew it was going to be tight, but close, he only had $86.
Wow.
I felt so bad for him. I got him a U-Haul rental truck because I'm like, that just sucks for him, right? All right. Verifying deposits for down payment. We send out a VOD, a verification of deposit. So documentation of assets include highlight 2 months of bank statements, front side, back side, all sides. That's why it says all pages, because typically your borrower won't give you all the pages. To verify available funds. A verification of deposit form will also be sent to verify the average bank balance. When the underwriter reviews the bank statements and receives a completed VOD, 4 questions are considered. Does the verified information highlight conform statements on the loan? Do they match the statement on the loan application? Is there highlight enough money in the bank to pay the cost of buying for the property? Has the bank account been highlight opened recently? And highlight, is the present balance notably higher than the average balance? Underwriters prefer to see highlight seasoned funds. That means they've been in the bank for the whole 60 days. Drop down to lender's insurance requirements. Providing, you don't need to know that. So what you do need to know is the lender has highlight insurable interest in the property. To protect the collateral, lenders and underwriters will make sure that the loan approval specifies the amount of insurance required. Property insurance, sometimes called homeowner's insurance or hazard insurance, is a policy that covers highlight loss or damage to the home or property in the event of fire or other disasters, such as we have all these tornadoes, snow, hail. Lenders generally require the policy to be highlight sufficient to replace the home or highlight reimburse the mortgage amount, with the lender being named on the actual policy. They have the right to place insurance on the property to cover the interest in the event of loss if the borrower does not comply with the lender's insurance. This is called highlight force-placed insurance. They require the borrower to pay the first year of insurance premiums in full prior to closing. You have to know that. First year is 12 months, right? And they're allowed a 2-month cushion. Top of the page. Incorporate the annual insurance cost along with other current property taxes into highlight an escrow account, which is prorated over the next 12 months to determine the monthly insurance and property tax payment amount. This is added to the monthly principal and interest due for the loan payment. Upon payment each month, the insurance and taxes are deposited into an escrow account. When the property tax and insurance become due, the lender pays them. Flood insurance. This is the stuff you need to know about flood insurance. Okay, how come it says, does it say that there? Yeah, flood insurance is there. Flood insurance. Property insurance does not cover the cause of peril of flood when a property is in a federally designated highlight special flood zone area. You have to know that, special flood hazard area. The lender for federal loans will require flood insurance policy for the life of the loan in addition to homeowners hazard insurance. SFHAs are areas with highlight 1% chance of being inundated, I can't say that word, by a flood in any given year. An SFH is also referred to as the base flood or highlight 100-year flood because it primarily determines its history of flooding. Flood maps are published by FEMA. You have to know that, highlight it. Who publishes flood maps? FEMA. They designate the zones and the levels of risk. Highlight high-risk areas. You have to know the high-risk area is Zone A. Also, just for shits and giggles, highlight Zone V as in Victor. So it's A and V. That's the high zone areas. Moderate areas are highlight B and X. Minimal areas are C and X. And then for the undetermined areas that would not have been analyzed, have a possibility of flooding, FEMA designates them as flood zones D as in dog. Flood insurance coverage is required to be maintained until the loan origination is satisfied. Obligation, sorry. So you have to have flood insurance for 30 years if you have a 30-year loan. The standard flood insurance policy only insures the home and not the homeowner's content. The owner purchases additional insurance. Remember that force-placed insurance is when the borrowers don't pay for their insurance. Top of page 95. Private mortgage insurance, we talked about that. That's PMI. Recall that PMI is offered by private mortgage companies to insure the lender, not you, the borrower, highlight the lender against default. It only pays the part that the lender loses, which is usually the top 20%. Title insurance. When conveying real property, the seller is expected to have highlight marketable title that's free and clear of any highlight encumbrances or defects that would expose the purchaser to litigation or impede the purchaser's ability to enjoy the property. The lender's title insurance policy is sometimes called highlight loan policy. So highlight lender's title policy, loan policy, issued only to the mortgage lenders. It is almost universally a requirement of institutional mortgage lenders and usually is included as the closing cost paid for the borrower. It guarantees that the lender is highlight made aware of all liens against the property and that its lien occupies particular position. In other words, if it's in first position, it has to be in first position with everything else below it. Escrow requirements for handling borrowers' funds. Don't touch them. They're like a hot potato. Don't touch your client's money. It always goes to escrow by a wire. The escrow account holds money for the purpose of paying taxes, hazard insurance, and other charges related to the property that some mortgage lenders collect every month along with the mortgage payment. Respa does not require lenders to impose an escrow account on all borrowers. However, certain loan programs require escrow accounts as a condition of the loan in order to better protect the lender and insurers. For example, a mortgage loan that highlight includes mortgage insurance will have an escrow account. All government loans require an escrow account. Top of page 95. A loan that meets the Truth in Lending Act definition of highlight a high-priced mortgage loan is required to have a lender-imposed highlight escrow account 60 months. Lenders are also required to collect monthly escrow payments for certain other mortgage loans for at least highlight the first 5 years of the loan. Respa Section 10, you have to know Respa Section 10, escrow requirements. Highlight Section 10 of Respa, sets limits on the amount the lender is required the borrowers to put into escrow. During the course of the loan, Respa prohibits the lender from charging excessive amounts for the escrow account. Highlight each month the lender may require the borrower to highlight borrower to pay the escrow amount no more than highlight 1/12 of the total of all disbursements payable during the year, plus an amount necessary to pay for any shortage in the account. In addition, the lender may require highlight a cushion not to exceed highlight 1/6 of the total disbursement for the year, highlight 2 months. The lender must perform highlight an escrow account analysis, highlight once during the year, and notify the borrower of any shortage. Any excess over highlight $50 or more must go back to the borrower as long as they are not behind in their mortgage. Loan consummation. This is when your borrowers are signing their loan docs in front of a notary. So loan consummation is the last stage of the origination process when the borrower becomes highlight contractually obligated in the loan transaction. It is when the mortgage note and security agreement become effective. Since the timing of this obligation is determined by state law, the timing consummation occurs may vary from state to state. The term highlight closing and settlement are synonymous with one another and do not refer to the loan transaction. These terms describe the end of a real estate transaction between a buyer and a seller. Closing or settlement is the process by which the term of the purchase and sales agreement is fulfilled, the appropriate parties sign the paperwork, funds may be dispersed, ownership of real property transfers from the seller to the buyer. Next page. Closing settlement. Couple more minutes and we go to lunch. Well, dinner, 15 minutes. Close, huh?
3 minutes.
Yeah. Close, dinner, lunch. Closing statement. Procedures. They're different from state to state. So we have some states that are wet states and some states that are dry states. California is a dry state and we have a closing. Well, we don't have a closing meeting. We have settlement. But the states that are wet states, they have a whole meeting. They have a closing meeting. So closing and settlement agents. A closing agent, sometimes referred to as highlight the settlement or escrow agent, is the person responsible for the mechanics of the closing. The agent may be an attorney or sometimes someone from the lender's in-house escrow department, an independent escrow company, or an insurance company. The closing agent facilitates the closing of the transaction between the buyer and the seller, sales transaction as per the sales contract agreement or a separate set escrow instructions. Highlight gathers all necessary documents and makes certain they're all properly signed. Documents the various adjustments and fees charged to each party, including debts that are sums of money owed. A debt is charged to a particular party to represent money that must be paid out. Credits that are sums of money received. Highlight credit, sums of monies received. A credit is given to a particular party to represent money that is paid to another party or that has been paid. The mortgage amount shows up as a credit. Highlight that. Mortgage amount shows as a credit to the borrower since the lender will bring that money to closing. You need to know that start. The settlement agent also calculates the various prorations, which are divisions of expenses. Highlight divisions of expenses between the buyer and the seller in proportion to the actual usage of the items represented by particular expenses as of the day the loan is funded. Completes the closing disclosure for the seller in compliance with the Truth in Lending Act, and highlight coordinates the closing with the lender who is responsible for preparation of the closing disclosure for the borrower and obtains necessary signatures on the loan note and the security instrument necessary for consummation, among other functions. Remember that the closing agent's the one that calls for the funding of the loan. So we call it the escrow agent and the escrow officer, and the escrow officer calls for funding of loan. Escrow officers do not underwrite a loan. There's a question somewhere around that says that the escrow can actually underwrite a loan, and obviously that's not true. So go and be free for 15 minutes, and then we'll start at closing documents, and then do the end of chapter 4 and all of chapter 5. So go, be free.